Okay, now we're going to start chapter 6, and chapter 6 and chapter 7, those two chapters talk about the three main measurements of macroeconomics. Chapter 6 looks at the nation's production, known as gross domestic product. Chapter 7 looks at unemployment and inflation. Now in chapter 6, we look at GDP, gross domestic product, is the main topic, but the title of the chapter is national output and income, because there's lots more measurements than GDP. We'll talk about some of them, but we're going to emphasize GDP because that is the broadest, most used measurement of the U.S. economy, and it's one that's compared with other nations around the world. Speaking of other nations, all nations keep track of their national product and national income accounts. And what's nice is this has been standardized back around the early 1990s, where every nation in the world keeps track of their national output and income accounts the same, except maybe some countries like maybe China, North Korea, Cuba may not trust their numbers. And in our country, the entity that does this counting, you might say, is the Bureau of Economic Analysis. It is under the Department of Commerce, and just Google BEA on the internet, and usually the first one will pop up, and that would be the Bureau of Economic Analysis. You can go there and get lots of data on all sorts of things for the U.S. economy at the macro level. And these national input and national output accounts are known as sources and uses of income, and these become input-output accounts. Input accounts show the sources of income, so it shows where income comes from, and then the output accounts show where the income goes, where we spend it. And so the broadest measurement of our output, where money goes, and what we produce, which is the same thing, is gross domestic product. And the broadest measurement of input is called gross domestic income. Oops, that should be income. And so GDP always equals GDI. Gross domestic product always equals gross domestic income, dollar for dollar. We'll find out at the end of the lecture or halfway through the lecture that because they come from different data sources, that they usually don't end up dollar for dollar, and we have to make a slight adjustment to have them equal at the very end. And so the first thing we're looking at is going to be gross domestic product, and that will be the main topic from this chapter. And so gross domestic product is defined as the total market value of all final goods and services produced in the economy in 1 year. Now we do have these numbers come out every quarter, every 3 months. But usually when we report it, it's reported as the number for the entire year. Now, first of all, we have to understand that GDP is measured in dollars. It's a market value. You may have heard the phrase, you can't add apples and oranges, and that is literally true. We cannot add them together because they're different units. One is apples, one is oranges, but we can convert them into dollars, and dollars is the same unit for apples and oranges. And so all of the production that's put into gross domestic product is all measured in dollars. And that actually makes it kind of easy. Most of the stuff we go into GDP is determined by the market. The market will set the value of these goods, the prices, through supply and demand. Second of all, it is domestic product only looks produced inside the United States. There's another measurement called gross national product, which measures things outside the United States and not everything in the United States, but GDP measures things only produced inside the United States. So we don't care if it's done by a Mexican citizen, a Canadian citizen, a German citizen, a Ethiopian citizen. What we care about is that the work is done in the United States. And that is what really matters. If the work is done here, then we receive the benefits of that work, plus we receive the income. It also measures what's known as final goods and services. So we don't measure everything that's produced in the year, because that will lead to double, triple, quadruple counting. So we only count final goods and services. These are goods and services that are not used for further processing, manufacturing, or for resale. So these are things that are purchased by the final user. So if you go to a Starbucks store and you buy a cup of coffee, you drink that coffee, you are the final user. That coffee, that cup of coffee that you purchase will go into GDP. If you go down to Home Depot and you buy a plant or a wheelbarrow, you are the final user of those items, and that would go into GDP. Other goods that are used for further processing, manufacturing, or for resale are called intermediate goods. An example of an intermediate good would be going back to Starbucks. When Starbucks would buy, say, the coffee beans to make your cup of coffee with, when they buy the beans, that would be an intermediate good. They bought those beans not to consume those beans themselves. They bought those coffee beans to process them into a cup of coffee to resell it to you. So most things in the supply chain are, if not everything, maybe I just have to think about that. But most things in the supply chain for a business would be intermediate goods, and then the final output that goes to the final consumer would be the final good. And again, we do that to avoid double counting, triple counting. For example, going back to Starbucks, if we would buy the beans, if we would count the beans that Starbucks bought and put that into GDP, and then we count the cup of coffee that you buy from Starbucks, we've counted those beans twice. And that makes no sense. So a good accounting procedure is that you want to count things once, and therefore we wait to the final user. And that's also a nice, easy way to calculate the value of things, wait until we get to the final user. Now, one way to also avoid double counting is to do what's known as the value added approach. This approach is to take differences between the value of goods as they leave a stage of production and the cost of the goods as they enter that stage. So you want to take the difference between what you paid for something and what you sold it for. And so I took this example from your textbook, at least the edition that I'm looking at. Let me go focus in there. Okay. So here we have 4 stages of production. We have oil. This is for a gallon of gas up there. So we look at the oil drilling, and so they drill the oil. The oil drillers drill the oil, and then they sell the amount of whatever used for a gallon of gas for $3, and that gets value added right there. And then that oil goes to someone who refines it, and they pay $3 for it, $3. They sell it for $3.30 after they refined it into gasoline. They added 30 cents of value to that. Then it gets shipped to the gas station in some kind of a tanker. They bought the gasoline from the refining company for $3.30. They sell it to the gas station for $3.60. They've also added 30 cents of value to that. And then the gas station sells the gasoline to us for $4, and they make a return of 40 cents on that. So they've added 40 cents of value right there. So if you add up the $3 of value added from the stage 1, the oil drilling, refining stage 2, shipping stage 3, retail sales stage 4, you get the same $4 right there that we got right there. So the final user approach is right here. And this would be the value added approach. Same end result. And a lot of companies keep track of the value added, but in terms of measuring the entire macroeconomy, I'm sure the Bureau of Economic Analysis does that, but it seems like, I don't know, it's a lot of work. If you go over to Europe, they have what's called a value added tax, and what they do is that everyone at every stage of production would pay the value added on what they add. And so, for example, if you are the refining company, when you sell your gasoline that you just refined for $3.30, they would tax you only on the 30 cents of value that you added. And then the final user, the consumer, would pay $4, would pay tax on the increase there, which would be 40 cents value added, which is what they will be taxed at that stage. Why they do it that way, I have no idea. Okay. Now there's different ways to find GDP, but the way that's probably the easiest, the way that's probably the most accurate, is to do what's called the expenditure approach. And again, that goes back to the final user. Now to do this, we have to avoid a few things. We have to avoid, first of all, sale of used goods. A lot of things that you and I buy are used products. You go to Goodwill, you buy a used car. These represent old output that is not counted in current GDP because it was already counted when it was produced. So if you buy a car from a used car dealer for whatever amount of money, and that car is a 2006 model, well, that car was already added in 2006 into GDP. We're not going to add it in again in 2020. You buy a shirt from Goodwill, we do not count that sale as part of GDP because that shirt was produced years ago, and that shirt was counted in GDP the year it was produced. Also, we do not count financial transactions. So, for example, if you put money in shares of stock, real estate, bonds, etc., none of that goes into GDP because it represents no new goods or services being produced. It simply is a movement of money around. So deposit the money into your banking account, buying 10 shares of IBM stock, buying some real estate, buying a savings bond, none of that would go into our GDP. Having said that, however, a lot of services are used here. So if, for example, you go to Goodwill, there is staff there. Well, they are producing a service this year, that would go into GDP for that year. In financial transactions, we have a lot of traders out there, a lot of brokers, a lot of financial advisors. All of that work they're doing this year to help us conduct these financial transactions would go into GDP. So even though we don't count the actual financial transaction itself, all the underlying support services, staff, all the salaries being paid out for all those people, that would all go into our GDP. And then we already talked about the sale of intermediate goods. They are not counted in GDP. I should say there's one exception because GDP measures production, not just expenditures, even though expenditures is where we pick up most of our GDP. But there's one problem with leaving out intermediate goods, and that is at the end of the year. At the end of the year, we have things in various stages of production, and we have to pick that up somehow because we want to count all the production for that year, whether or not it's completed or not. And so the way we go about GDP is we look at 4 sections of expenditures. We look at consumer spending, called personal consumption expenditures. We look at business spending, called gross private domestic investment. We look at government spending, government consumption expenditures, and gross investment. And then we have international trade, known as net exports. And so the next lecture is going to look in detail at these 4 sections of expenditures. And we'll stop there.